Friday, the 8th of July, sees the release of the non-farm payroll data, the US jobless numbers, which come through once a month, first Friday of the month. Mike Ingram from BGC Partners joined us now. Mike, it was such a dismal number last time, and there's no other way to describe it. Well, everybody's got it a shockingly low number last time. Is there any risk, do you think, for a repeat of that this month?
Well, there's always a risk, isn't there? And it wouldn't take a lot to turn markets around from where they are at the moment. I think part of the issue around those awful non-farms in May was the ADP number sent through everybody a loop. They said, "Oh, that ADP number on the Wednesday looks fine," and then on Friday, bam, 38,000. Market was looking for something about 4 times that. And yes, okay, the Verizon strike knocked something like 34,000 off the numbers, but even adding that back, that's a dismal number. And
what about this month? Yes. We're looking here for a June figure, of course, aren't
we? In the region of 175 at the moment on my consensus, and I think almost as important actually is going to be the what's happening with average hourly earnings. So one of the reasons, of course, why the Fed looks at the non-farm payrolls is it's all to do with the Phillips curve, how much slack there is in the labour market, because they think, well, if there's less slack, there's more inflationary pressure, and of course, inflation is the other part of the Fed's mandate. So the worst possible combination is to have a low number, and certainly I think after that 38,000 number for May, anything even close to 100,000, even if it's slightly above 100,000, is going to be taken as, again, another weak number. If you've still got average hourly earnings at 0.2 month-on-month, about 2.5% year-on-year, you'll say, well, hang on a second, it's very clear that job creation is coming down quite dramatically, the run rate's coming down quite dramatically, but wage pressure is actually remaining high, and therefore, with the Fed with an eye on its own inflationary mandate and an environment actually where the dollar is weakening again, isn't necessarily going to be quite so relaxed on interest rates as market might be thinking. Because at the moment, the market's thinking that virtually any chance of any rate rise during the course of 2016 has pretty much evaporated. Yeah, and of course, as they get on further on in the year, they wait, then of course they've got the US elections coming up, which is going to cause an extra problem for them. Indeed. I mean, what's going to help in the meantime, however, are these minutes that we're going to see from the Fed on Wednesday, because of course that will be after the May number was booked. So it'll help contextualise the Fed's thinking about the non-farm numbers that we're going to see 2 days afterwards. So that, I think, should help. But of course, you never quite know what's going to be in the minutes. It can be a very mixed bag, I'm afraid. Okay, all right, Mike, thanks so much indeed. Mike Ingram there from BGC Partners. Just to recap, Mike's there looking for 175,000 jobs to have been found in the US economy in the month of June, with a 0.2% print on average hourly earnings month on month.